This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning. Welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Francine this half hour. Here's what's coming up on today's program. Moderating inflation, U.S. CPI cools in April, giving the Fed scope to pause rate hikes. Meanwhile, Treasury Secretary Janet Yellen warns a debt default would spark a global downturn.
Default is frankly unthinkable. America should never default. It would be tremendously economically and financially damaging.
More hikes in Europe. The Bank of England is set to raise rate for a 12th straight meeting today. The ECB's Joachim Nagel tells Bloomberg the central bank is getting closer to restrictive policy, but isn't there yet.
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down.
The ECB's consumer inflation report is hitting the tape now, feeding into those comments from Nagel. The ECB saying that consumer inflation expectations rose significantly. This is for the month of March. They are seeing higher inflation expectations than they did the month before, than they did in February. Yes, this is backwards looking, but it is reigniting this fear of entrenched inflation in Europe. Is the ECB going to have to keep hiking? We'll take a look and see in a bit whether that's moving bond markets. We also just minutes ago got Emirates Group earnings crossing. Reminder, this is not just the airline, it is the bigger company. Profit, 10.9 billion dirhams. They're going to pay a dividend of 4.5 billion to the owner ICD. These are very strong numbers, represents a significant turnaround for the group. So that's some of the earnings. That's the big picture. It is inflation on the mind of everyone. Are we going to see this divergence between the U.S. and Europe? Not just the U.S., by the way, China, too. Inflation not picking up. We thought this would be a big source of inflationary pressures throughout the globe. It's not playing out. Now, part of that is giving a boost to equities today. Yesterday's strong session in the U.S. Let me show you what we're seeing in Europe so far. European stocks up 0.5%, more than 0.5%, I should say. It is a session of buying for bonds, 10-year yields, those lower by 1.5 basis points. I did want to point out just how strange this curve is. Basically, the whole curve is moving lower, except for the very front end. Why is that? We're pricing in this risk of a default. It's not hugely priced in. Bloomberg MLI pointing out that it's only about 3%. Even so, the most inverted we've seen in 1 month 10-year yield curve since at least the 2000s, since we have data going back. Copper LME, I just want to point this out because, again, it's that China story. The growth there, the strength, not as strong as we thought it would be. Producer prices, those disappointing, those fell. So copper taking another leg lower over that concern about global growth, down 1.5%. Now, just to show you the overall European picture, most regions are higher today. Maybe a little bit of lagging from the DAX. That's only up just less than 0.3%. We had some earnings today. Bayer, ThyssenKrupp, a lot of big German companies which weren't as strong as many had hoped. Kallum, that's doing well, up 0.8%, up 0.5% for UK stocks too. Now, we also heard from Treasury Secretary Janet Yellen early this morning saying that a U.S. government default would undermine Washington's ability to provide international leadership. She was speaking at the G7 summit in Japan and called such a scenario unthinkable.
A default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced, American businesses would see credit markets deteriorate, and millions of American families that receive government payments would likely be left without the resources that they were promised.
Don't miss our exclusive conversation with Janet Yellen. That will be tomorrow morning at 8:30 a.m. UK time. Now, the other big piece of U.S. news, inflation showed signs of cooling in April, opening the door for the Fed to pause rate hikes soon. CPI rose by 4.9% from a year earlier, making the first sub-5% reading in 2 years. Joining me here on set is Christine Aquino, managing editor of Bloomberg Markets Today. It does feel like the sigh of relief, Christine. I mean, if we're getting this CPI reading, it's hard to see what could really happen to really change the picture, say, for perhaps a U.S. default before the next Fed decision.
Yeah, that's it, Danny. I mean, obviously, lots of worries growing now over potential U.S. debt default, but at least inflation is giving markets some relief here. And yeah, I think that number really cooled a lot of expectations that may still be out there for the Fed to keep going after this month, potentially. But I think it really just affirms the latest message that we got from Fed Jay Powell himself, saying that they are potentially ready for a pause here. And if you look at the components as well, quite interesting. A lot of them are kind of the transitory sort of inflation, right? It's gasoline prices, and I think a little bit of the used car prices making a bit of a comeback. I mean, these are things that are kind of more seasonal. It's probably happening because we're ahead of the summer driving season in the U.S. But all in all, looking a little bit less sticky and some relief.
Are we going to start talking about immaculate disinflation again? Because the labor market is still really strong. I mean, it goes back to this thing of, is the Fed's job truly done if we're still seeing things like wage pressure?
Yeah, I mean, that is the big question, isn't it? And if you just kind of look at the core measure, I think it would be hard-pressed to say that the Fed is truly done, right? Because even that is, that's kind of the flip side of the inflation number, is that core has remained in that range of 5.5 to 5.7% since December. And so that really hasn't budged at all. And I think this really just drives home the message as well, that the easy part of the Fed's job in reining in inflation is behind us. It was kind of getting it from near double digits to where it is now. That's really the easy part, you know. It's now kind of bringing it back down to that 2% target, which is looking really quite far away by the day.
Yeah, and it's like, do we have to have a hard landing in order to get to 2%? Christine, always such a pleasure to start the show with you. Christine Aquino there, a managing editor of Bloomberg Markets Today. Now, contributing to perhaps some slower global inflation, China's consumer inflation slowed to the weakest pace in 2 years in April, while producer prices fell further into deflation. Joining us now is Bloomberg's Jill Desis in Hong Kong. Jill, what happened? Because it was not that long ago that everybody was talking about the fact we get this global inflationary pressure coming from China reopening. I mean, that's not playing out.
No, it's really not, Danny. I think that what you're looking at here is, perhaps some more trouble signs for the economic recovery. I mean, at this point, look, economists were thinking that there was going to be a drop-off, a slowdown in inflation in China. I think 0.3% around was the estimate. I mean, we almost fell into deflationary territory with consumer inflation in April. You're looking at maybe some additional pressures, some slowing domestic demand that I think is sort of calls into question even further the state of the domestic, economic recovery here. And it also, look, there's been so many signs recently with a bunch of other points of economic data that have been somewhat troublesome. Manufacturing activities falling off in April. We also saw a drop off in imports, a slowdown in export growth. And also, I mean, I'm just looking now, there's a headline that just crossed the terminal about credit expansion in April. It looks like we're still getting some of that data, but ultimately that's coming in quite a bit weaker than some estimates. So ultimately, all of this is sort of forming the picture that the economic recovery in China right now, maybe there's some questions about sustainability, and we're going to have to see whether that continues into May and then June.
Maybe kind of a piece of good news for Europe and the U.S. who are still trying to fight inflation. Jill, thank you so much. That's Bloomberg's Jill Desis in Hong Kong. Speaking of fighting inflation, coming up on the program, sticky inflation is fueling bets the Bank of England will raise rates again. We're going to discuss that with Martin Weale, former BOE MPC member. And we're also going to hear from the man himself, the BOE Governor Andrew Bailey. That will take place at 4 p.m. London time. This is Bloomberg.
I think, first of all, it was important that we hiked rates last week. I think it confirmed our commitment that our monetary policy path is not over to fight against inflation. Inflation is still very sticky. It is a very stubborn phenomenon. And as I said several times, you have to be even more stubborn. That means for me that story about hiking rates is not over. We have to do more. So there are 2 more meetings before the summer break, and let's go.
So you said that it was likely in the home stretch, whereas Christine Lagarde has talked about there's still more ground to cover. And inflation has been stubborn, and core inflation has been stubborn in Europe, and it's seen picking up in places like Italy. So 2 more possible hikes by July. What about September? Is that off the table or definitely a possibility?
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
Mm-hmm. How long would if they pause in July, how long a pause would you anticipate? I think the longest time that they would stay at that peak has been seven months or so. Would you see that as a good benchmark?
So again, I do not know where we have to stop. But when there's the point coming that we could more or less stop the rate hikes, then I have to believe we have to stay there for a while to wait what is the impact, what we did from the past, to see are we really successful or not. And this is very important.
Well, how long of a sustained drop, if you will, in core CPI would be enough?
I think what I see in the numbers is that it will take at least 1.5 years till we see numbers that are close to our target. So we have to be patient here.
I know Barclays was predicting a pause and a pause until the second half of 2024 and then hikes. Is that something that would be feasible, or is that too far to predict what the data might say?
This is would be also speculation. So what I see is that we have to wait for the incoming data, and then we will decide. So this meeting-to-meeting approach, this is the right way to do monetary policy in these days.
Bundesbank President and ECB Governing Council member Joachim Nagel there speaking exclusively with Bloomberg's Stephen Engel. So if that's the view from the ECB, here in the UK, there's stubborn double-digit inflation, which is set to force the Bank of England into a 12th straight interest rate hike today, even though the end of its lightning-quick hiking cycle is coming into view. Let's get over to UK correspondent Lizzie Burden, who's outside the Bank of England with a special guest. Lizzie.
Thanks, Danny. Well, as you say, a quarter-point hike from the Bank of England's looking pretty nailed on today. Markets and economists in agreement, but where they don't agree is what is the future path for rates. Well, joining me now to discuss is Martin Weale, Professor of Economics at King's Business School. Martin, thanks for being back on Bloomberg TV.
Hello.
You are a former member of the Bank of England's Monetary Policy Committee. Do you think that a quarter-point hike today should be the bank's last?
I really don't know. I mean, the bank on occasion has tried to give guidance about where interest rates go. I voted against forward guidance in August 2013, and when it became clear the policy had failed 6 months later, the MPC produced a statement which said that the actual interest rate would depend on the actual state of the economy, and that's really all the MPC can say or should say.
But they should hike again today.
I certainly think that if I were on the committee, I'd be voting for an increase again today, yes.
You're also an honorary fellow at NISA, the think tank. It says that inflation won't be halved by year end, which of course is the Prime Minister's #1 target. Do you agree with that?
Well, I think there's a real risk. We've seen inflation being more persistent than had been expected even 3 or 4 months ago, and particularly with the high level of food price inflation, that's the sort of thing that is likely to sustain pressure in the labour market, and that in turn means that businesses are likely to be having to put up their prices. So whether things will turn out as the National Institute has forecast, I don't know, but certainly there is a real risk that Sunak's inflation target won't be met, and I actually think he would have done better to leave discussions of inflation to the Bank of England.
And you mentioned forward guidance, but on the Bank of England's comms in general, the chief economist's got in some hot water for saying that Britain should accept they're poorer. Was he right to do that?
Well, the reality is that the country is poorer. People focus on GDP, but actually a much better indicator of living standards is what's happening to national income, and that has fallen fairly sharply because of the increase in gas prices.
And on fiscal policy, there is lots of calls for the Chancellor, Jeremy Hunt, to cut taxes before the next election. Is that a good idea?
Well, my view is that the national debt is high. We seem over the last 20 or 30 years to have lived in a situation where it goes up when something unpleasant happens and doesn't go down, in more normal circumstances. So all that tells you is that the national debt is going to rise indefinitely, and I think that's a signal that cutting taxes now would give.
And one of the reasons that we've got double-digit inflation in the UK is, of course, the tight labour market. Has the government done enough to plug the holes in the labour market?
Well, the government has done something. We have to see how much effect it will have. It's true immigration has been higher than was expected, but I think we are still suffering first from the effects of Brexit and the limits that's placed on immigration from the rest of Europe. And secondly, we're suffering from the people who've dropped out of the labour market in the aftermath of the epidemic. Maybe they will decide to go back to work as they discover that their pension savings don't last as long as they'd hoped. I don't know.
And of course, we'll soon get more jobs data. Are we underestimating the price-wage spiral in the UK?
Well, I think we have seen a price-wage spiral. It's perfectly true that wages haven't been going up as much as prices have, but I think most people would say that the reason that private sector regular pay is growing at about 7% is because inflation has been so high over the last year and a half or so.
All right, Martin Weale, Professor of Economics at King's Business School, thank you very much for joining me. Back to you, Danny.
Lizzie, fantastic interview, a good setup for a few hours' time when we get the BOE decision. Bloomberg's UK correspondent there, Lizzie Burden. And of course, we're going to be bringing you that decision 12 p.m. today, and special coverage of the news conference. And Bloomberg's Guy Johnson will be sitting down with BOE Governor Andrew Bailey. We're going to bring you that interview today, 4 p.m. London time. But first, coming up on this program, no magic. Disney is seeing a wider loss in its streaming business after losing subscribers for 2 straight quarters. We'll have more on their outlook next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Disney shares are down in the pre-market trade after reporting a drop in subscribers to its streaming service. This is also happening as the U.S. media giant predicts a wider loss in that business this quarter. Joining us now for more is Bloomberg's Alex Webb. So we're down, nearly 5% in the pre-market. What do these subscriber losses mean for just such a giant like Disney?
There'd often been a conversation about what is the base layer when it comes to streaming, that ultimately that's what people thought Netflix was. So you'd have Netflix and then you would add other things on top of that. That thesis started to fall apart a little bit, but this does start to make it look as though Disney is very much a discretionary piece, that actually Disney Plus isn't the streaming service that everybody feels they need. It's something that, if you like Star Wars or Marvel, perhaps, and kids' films, then you might get it now. There are a lot of people that do like those 3 pools, but it's not everyone, and not necessarily everybody feels like they need them. Also, some of the new content coming onto Disney Plus hasn't been quite as exciting as the first flush that we saw. That seems to have taken some of the wind out when it's compounded by the economic circumstances.
So given that, how much visibility do they have going forward? Because as you say, the economic circumstances, there's just still so much unknown at this point.
Well, they telegraphed that in this quarter there's going to be a $100 million, worse hit to their earnings as a consequence of marketing spend, which presumably is an effort to bring some of these subscribers back. There are renewed efforts now. He said Bob Iger, the CEO, said he's going to try to integrate Hulu, which is technically a sort of joint venture. It's 75% Disney, 25% Comcast, the parent of NBC Universal.
Right.
Disney has a right to buy that at a particular price. It increasingly looks like that is going to happen because he says he's going to try to merge Hulu into Disney+.
Oh, that's interesting because Hulu is maybe less discretionary. I remember when I lived in the U.S., Hulu was a must-to-have to watch all the shows I wanted to.
But the thing that's interesting, actually, if you're here in our part of the world, if you get Disney+, all the shows that are on Hulu in the US are on Disney Plus in Europe, right? And so it already is the case in the rest of the world. It's really only in the US's home market. Think about it. You get Handmaid's Tale on Disney Plus in Europe. In the US, you have to have Hulu and Disney Plus if you want to watch Handmaid's Tale and The Mandalorian, for instance. So it's bringing more, it would be in the US, bringing more sort of grown-up content, as it were, onto the main Disney Plus platform.
Alex, thank you so much for that. That's Bloomberg's Alex Webb on Disney earnings. Now, coming up later, Francine is going to be sitting down with JPMorgan Chase Chair and CEO Jamie Dimon. Stay with us for that. Plenty more interviews ahead. This is Bloomberg.
Good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in Paris with a special focus this week on finance in the UK and Europe. Now, over the next half an hour, we're here in the French capital. It's increasingly in the corporate spotlight after Brexit, and I'm here for JPMorgan's Global Markets Conference. So we'll have plenty of interviews, and of course, we'll look at the markets. Later, we'll bring you our exclusive interview with the bank's Chief Executive Officer, Jamie Dimon. That's at 1:15 p.m. London time. And then a little bit after that, back in the UK, of course, we know it's decision day from the Bank of England. They're expected to raise rates another time, and we'll bring you our interview with the Governor, Andrew Bailey, later today, and that's at 4 p.m. London time. But let's start with a catch-up on the markets. Let's begin with Marc Badrichani, JPMorgan Securities Head of Global Sales and Research. Marc, as always, thank you so much for coming on. Markets are all over the place. We have investors, we have a lot of analysts saying, look, a recession is near, a credit crunch is arriving, people are hiring less, and yet the markets are range-bound. What's your feeling?
You're absolutely right. First, welcome to Paris, Francine. You know the city well. We had you last year, we have you this year. We have more than 1,000 people this year. I think, for the first time, people are coming back from Asia. Like last year with COVID, they were not. So with that said, as you said, and you have Jamie later on, you look at all the bad news out there, and there are plenty. You have debt ceiling in the US. You have regional banks. You have inflation. You have the Bank of England later today. So you have many reasons, and our clients are telling us we have many reasons to be negative. Having said that, every day that goes by, the market goes a bit higher. So the question is, what do people really think? They think there is recession and should go lower. What is happening is probably not exactly the same.
So I don't really understand market behavior. Is it because people are still fully invested? Is it because of the private markets and the fact that there's still no real alternative? Or is it really that...
It's a great question. And if you remember last year, we talked about what people were thinking about commodities. Yeah. And I made the point making the difference between what people think and what people express in their investment. So we had a survey this morning at the conference. A lot of people are still invested in cash. A lot of people see, when you look at the fixed income markets, rates and commodities to a certain extent, they're pricing a recession. Equities is not. Now, I went to Middle East a few weeks ago. I went to Latin America, between New York and London. Everybody thinks the same. Equity markets are too high.
But no one does anything about it.
No, but then you have to ask yourself, the question is, do they think they're too high because they would like to invest more? Or do they think they're too high because if you look at rationally and objectively at all the risk out there, they are too high?
What is the chance of the mother of all crash coming in our face, given all these idiosyncrasies?
That's the million-dollar question. If you're the glass half-empty person, you look at all these things happening around the world and you think something is going to crack. And the second question that our clients ask us is, what are we not seeing? Is it commercial real estate? Is it the debt ceiling? Is it something else that is more systemic in the market? Today, we don't see anything systemic. That doesn't mean we're right. Then you have the glass half empty, a half full version, which is we have a war. We had the biggest energy crisis in the world. We have tension between Russia and China. We had the biggest pandemic, yet the global economy is doing well. So
what are your clients saying? Because you also look at the debt ceiling, and we were, last night being briefed by your head of research, Joyce Chang, on the U.S. default potential that not many people understand. Certainly the market at the moment seems to be ignoring it.
clients are worried and clients are afraid the level of conviction is relatively low. So yesterday we had a roundtable with credit investors. The two biggest themes, debt ceiling and regional banks in the US. If you had the similar dinner in the US, people would talk still debt ceiling would be one. They would have a much more negative view about Europe from the US than in Europe. You look at Paris, you walk around, like, A, people now speak English in restaurants, and B, restaurants are full.
And less rude sometimes?
Less rude, absolutely, yeah.
And so what does that mean? I don't know whether we look at a world where everything's a bit more fragmented or whether there's just a misunderstanding between the regions which create opportunities.
I think the one thing that has changed compared with the past is that central banks are much more quick in acting. So every time you have a bump in the road, whether it was LDI in the UK or the regional banks in the US, the central banks are very quick to act, sometimes quite impactfully, I mean, always impactfully, but sometimes very forcefully. And therefore, you could imagine a scenario where, unlike what we had pre-08, where we were like boom and bust, you could have scenarios where every time there is a little adjustment, you have an adjustment on the market. Having said all that, I do believe like today there is a bit of a decorrelation between the fixed income market and the equity market. So something has to give and something have to adjust.
Do you worry that central banks were too quick to act, or if not quick, too forceful to act, so that there's a lag in monetary policy?
It's very easy to criticize the central banks ex ante. Like the reality is, it's a very very complicated work. Were they too slow to act on inflation? Looking back, absolutely. Should they have done more? But if you're the Fed today, it's a very fine balance between fighting inflation and until what level will you be ready to accept? If inflation were to settle at 3%, is that acceptable or not? And not hurting the financial system, especially with the regional banks. So for them, finding that equilibrium is probably very difficult.
And again, inflation, understand. So we focus a lot on what central banks do without really understanding what inflation will do. So we're looking at the problem,
that's
right?
Thing. But you see, when you talk to clients, they're probably less concerned about inflation today than they were, say, 6 months ago, because they've seen a decline in inflation. The UK probably, yes, it's still sticky, it's still at a high level, but from an investor point of view, they say, okay, we're on the right trend. Okay, then now, as we know, inflation, and it was funny, like spending time in Brazil and Mexico, when you speak to clients, say, no, you guys don't understand what inflation is. It will take a while. And they're right. Okay, and probably in the West, in the US and in Europe, we're hopeful that inflation will go down quicker than it really is. But it's on the right track, and therefore you have reasons to be optimistic there.
So we also spoke to a number of big investors in France over the last couple of days. Is refinancing a problem? I know we always talk about commercial real estate, but the fact that interest rates have gone up so much, how much stress in certain parts of the market is there going to be?
There will be stress in the market. So one area that people are very focused on is commercial real estate. But then once you unpeel the onion, in commercial real estate, you have office and you have the rest. You could say, well, office is very challenged, especially with working from home model. The reality is, if you have an office in San Francisco, yes, that's very challenged. If you have the same office space or newer office space in Miami, you're okay. Like you're oversubscribed. So even there, it's very hard to distinguish the two. The other thing is, it will take time. It's not like you have a wall of refinancing overnight. All these things happen over time, and you have deep pockets sitting on the sideline, like PE firms and sponsors who probably see it as an opportunity.
So last time I spoke to you, there were a number other challenges.
Yes.
Are you a glass half full kind of guy? Because actually, so we saw the banks. JPMorgan played a role in this with First Republic. There was, of course, ETFs. There was Credit Suisse. But overall, the system has held.
The system has held. And overall, if you see, like, Credit Suisse getting bought by UBS, a few regional banks going under in the US. Despite all that, the system is functioning well. And even when we look at what happened last year, you had like S&P going down quite a bit and in a relatively orderly way. And every time you had a bump in the road, I think between the market players and the central bank, it ended up in a good way. So I am a glass half full guy. especially when I travel. I think it's kind of, and if you haven't been lately, go to the Middle East. You're like, that's probably the high end in terms of how positive you can feel. But even in countries without China, yes, but even with, yes, not all of them, and even with oil coming down, I think the word is, and again, as I told you, biggest pandemic, you have a war, you have tension between US and China, you have the debt ceiling. Despite all that, the global economy is growing.
Marc, it's also a decision day for the Bank of England. What do you do with the UK? I don't know whether there's a strong inflation. I think there's
stronger. Like inflation is probably more challenging in the UK because you have a combination of everything that's happening in the world and Brexit and transition. And you had a change of governments. I think our house view is they hiked by 25 basis points, split vote 7-2, probably another hike in June. We'll see. It's kind of we're confident. We see you look at London, it's vibrant. There's still things happening. So it probably take a bit longer, but they will get there.
Do clients ask you about the UK or
less so? So if you're here on the continent, people are probably less focused on the UK. In the US, they would. In the Middle East, they absolutely do. And London remains the number one finance place in Europe. So I think that's where it's happening. Now, Paris is a big hub for us. We have 800 people. We have to have that. We have to service our clients. But it's and we work well between the two.
Are we underestimating actually a lot of the geopolitics with China?
Yes, and I'm sure you'll discuss that with Jamie tonight. That's the biggest concern for our clients. So today, when we did the poll, number one biggest concern was geopolitics, especially since when you look at it, you have tension escalating between the US and China almost by accident more than by design until you had the Biden-Xi summit. I think things have escalated. From what we hear, from what we see, what our clients believe is that's definitely the biggest risk out there. And clearly people would like to see a resolution on Ukraine.
Yeah, and it's difficult to trade, actually. Geopolitics, the problem is that traditionally...
Almost impossible to trade.
It's impossible. So
We had a question on China, if people were investing in China, wanted to invest more. And if you look at the answers, it goes from uninvestable to I'm underweight, I need to increase my exposure.
Marc, thank you so much, as always, for joining us. Marc Badrichani there, the JPMorgan Securities Head of Global Sales and Research. Now, we'll have plenty more from here throughout the day. Coming up, Paris reaps Brexit benefits as it seeks to take London's limelight as Europe's biggest finance hub. So we discuss that next with our Lionel Laurent. This is Bloomberg.
I would definitely think that Paris is probably the best positioned city and France country in establishing the new continental financial services hub, definitely from an asset management perspective.
We invested quite a lot in Europe and we decided to establish a sales and trading hub in Paris.
Brexit has been, in my view, an accelerator. But the reason why Paris is so well positioned now, it dates probably 10 years, 20 years back.
We worked on the legal framework, on the fiscal framework, so that it could be a place to attract new investments. And we have seen the effect concretely. So more and more banks or financial institutions are joining Paris.
The strike, is not unique to Paris or France. I think we had waves of strike across Europe. I don't think strike will obviously put at risk any investors going forward.
There's clearly the bad image, but then the real substance is the infrastructure and the ecosystem that has been built over time.
It's a very diverse in terms of financial services that come into play in Paris. And I think what is important is we continue to see investments in Paris and investors growing there.
Business leaders there on how Brexit has actually benefited Paris. Now, joining us now, Bloomberg opinion columnist Lionel Laurent. Lionel, first of all, it's very exciting because I think it's this week that you launch a Paris edition of a newsletter, and so you'll be focused on finance and trying to figure out really how France is benefiting from Brexit. So We hear, I mean, JPMorgan does a conference here, a lot of the other banks. How much has it benefited?
Hugely, hugely. I mean, Paris has had obviously jobs and capital coming from London. Brexit was the big starting point because US global banks had to have a base on the continent. What's fascinating, though, is that Brexit is only part of the story. Obviously, Macron had pro-business reforms that made France a better place to do business. But also COVID changed the game immensely because remote work and having local hubs started to make business sense for the banks, and Europe was more integrated after COVID. So it's a lot of catalysts, with Brexit being the biggest.
But, Leona, I guess the question is, what kind of numbers are we looking at? So, of course, if you have to service your clients, and if you have some top earners that you want to keep happy and they don't want to go to Frankfurt or they don't want to go to Amsterdam and they want to come to Paris, you keep them here. But does it make business sense hiring here? Because it's so difficult to then restructure, for example, the organization or the union if something were to happen.
I think the direction of travel is just unmistakable, because I think now we're seeing a model where bankers want to be face-to-face with their clients on the continent, and they are happy with checking with their colleagues via Zoom, remotely, or other ways. I think the model has changed. I think that's not going back, because transport costs, inflation have gone up. The European talent pool is now accessible really only from Europe. So I think local models today make more sense for banks, even if overall they would not have wanted Brexit to happen. They like efficiency.
So how does Paris, have an advantage over Frankfurt or other financial hubs in Europe?
I think Paris has the advantage of being centralized. It has big mega cap companies. It has the biggest banks in Europe. It has obviously culture and schools. Basically, it's a place where bankers actually want to live and work, as opposed to the place where they feel they have to go just to keep their job.
At the same time, Lionel, you've been writing some great columns, of course, on some of the strengths of some of the French banks. Again, they've been outperforming some of the rest of Europe. What are the French banks getting right compared to the Italians or the Germans?
Well, I think overall, Europe is economically doing better than anyone thought after COVID and after the energy crisis and the Ukraine war. I think what's happening now is we need to see that continue. We need to see the real economy. I mean, if Paris has to benefit more, the French economy has to keep growing. And that's the challenge, really, for the outlook. Can Macron keep reforming and keep investing? That's the big question.
We saw, frankly, Paris burning. We saw a lot of the reforms with people on the streets, a lot of public anger. Does that influence, bankers wanting to live here? And does it make companies think twice about creating a larger hub here?
Well, France, I know France. Pension reform is tough everywhere. We're seeing strikes everywhere. I think that is seen as a temporary thing, because fundamentally, income inequality is relatively low in France. Inflation looks better in France than even in the UK. I think the question is, all of this depends on French debt and French government support. How is that going to continue if debt is being stretched as a proportion of GDP and if Macron is politically constrained? So that's the issue for the future.
But how difficult is it actually for President Macron? Because I remember his famous speech saying, look, we're going to roll out the red carpet for entrepreneurs, but also some of the bankers. How difficult is it, as a former hedge fund guy himself, is it to help finance, come to Paris whilst dealing with this huge, social unrest and cost of living crisis?
I think it's difficult, but the political story and the economic story are diverging in France. Politically, no question, there's gridlock in France. Macron has a huge uphill struggle to get his reforms through. But economically, you just have to admit that France is not doing too badly relative to other countries. That's part of why bankers stay here and think there's a reason to stay here. It's not just Macron rolling out the red carpet, it's the rest of the economy.
So, I'm excited about your newsletter. I think it comes out tomorrow for the first time. What time?
So it's coming out Saturday. We're doing a kind of weekend takeover of the Brussels edition. No, we work 24/7 at Bloomberg, even in Paris. We're going to take over the Brussels edition newsletter, and it's going to be a weekly roundup of everything you need to know from the ground, local knowledge, but with a global perspective, news, views, markets, finance, economics, luxury, the whole gamut from Paris, but for a global readership.
Great. I'm going to subscribe. You subscribe, right? You go online, you log in and subscribe. Yes. There you go. Lionel, thank you so much for joining us. Lionel Laurent from Bloomberg Opinion, and now newly minted newsletter in charge as well. Coming up, we'll discuss what the future holds for London after a barrage of criticism from some city leaders. We'll have a full roundup of that criticism and those critics next. This is Bloomberg. JPMorgan's top executive in Europe says Brexit has cannibalized London's listing pool. Now, data compiled by Bloomberg actually shows listings in the English capital have raised just $18 million so far this year. That's less than 1% of Europe's total. Now, Will Shaw from our finance team joins us now. Will, what does the future then look like for London? And good morning.
Good morning. So I think the first thing to say is that London remains by far the biggest financial centre in Europe still, as a major caveat, and that's in terms of staff numbers, assets and volumes of business. However, like you say, there are signs of trouble at the mill in terms of listings and equity capital markets. There are a few different reasons for that. Particularly geopolitical reasons. You know, as we know, Russian listings have dried up. China tends to be more domestically focused. But whenever you're talking about the UK, you obviously have to factor in Brexit. And as Viz Raghavan, who's JPMorgan's chief executive for Europe, the Middle East and Africa, was saying on this programme a few days ago, Brexit has effectively cannibalised the London listing pool.
Yeah. So, well, I guess the question is, there are many firms that could have IPO'd in London who basically said no thanks. I mean, what's the step forward?
So I think the big one here to look at is Revolut as a bellwether for what's going on. Now, their co-founders gave a very outspoken interview to The Times just a few days ago. They said they had no intention of listing on the London Stock Exchange. They had a laundry list of problems that they pointed to. They said the regulatory environment was unclear, which made things uncompetitive completely, particularly when compared with the United States. They talked about red tape, about high taxes, and a skills shortage from Brexit. So generally, you know, there is a sense of pessimism around listings in the UK. Again, I'd come back to that caveat. You know, a lot of the talk at the moment is about Paris, about how well France is doing. The UK remains like very dominant in terms of financial services.
Will, thanks so much. Will Shaw there from our finance team. Now, don't forget also to listen to our podcast, and you can subscribe to In the City as well. It's the one I host with David Merritt, and you can find Apple Podcast, Spotify, or wherever you get your podcast. New episodes drop every Thursday, and today we talk about some of the CBI scandals. A reminder, BOE decision, that's at 12 p.m. London time, and then we have a special interview with the governor. This is Bloomberg.
That trade-off of kind of stabilizing inflation, stabilizing growth is so hard for developed markets the world over, but it's almost particularly for the Bank of England.
Quite a significant amount of tightening has been done since the cycle began. Rates are in restricted territory, and we know that monetary policy acts with lags, so potentially the real effect of these hikes is still to come.
If we are cutting rates in the UK, it's probably because something's gone wrong.
This is Bloomberg Surveillance Early Edition with Anna Edwards and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. G7 nations will announce a joint effort to counter what they see as economic coercion by China. Meanwhile, Treasury Secretary Janet Yellen fires another warning, saying the debt default would hurt U.S. international leadership. The Bank of England comes out today with another decision on interest rates. Economists expect a 0.25 percentage point hike. And shares of Disney are lower. The world's largest entertainment company posted a drop in subscribers to its streaming service and warns there will be a wider loss this quarter. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kriti Gupta in New York. And a lot of focus on the Bank of England, of course, where I am. Kriti, more globally, we see risk aversion perhaps in FX markets, but not in stocks. Stocks seem to be higher.
They do, but look, it's coming on the background of about 2 days where we are lower in the stock market. So you are seeing a little bit of perhaps a reversal showing up in today's session. But the question is, what is driving it? Is it the macro or is it the micro? A lot of eyes, Anna, on that BOE decision, like you just said. And it actually does have consequences for what we're going to hear stateside, specifically in the FX market. But remember, even the FX market has ripple effects into the stock market. Let's start from the top bottom. S&P futures higher by 0.3%. But again, this is not something that I would call major conviction or major momentum. Anything can change as we we see the BOE potentially issue further warnings or talk about further rate hikes, because that's going to have a ripple effect on the U.S. bond market, which brings me to our 2-year yield, 393, sustainably below that 4% level. But look, we are still hovering around there. So technicals really driving the bond market in the absence of a more sustainable catalyst, like some sort of solution to the debt ceiling debate. That meeting coming tomorrow, of course, higher by 2 basis points at the moment on the front end of the curve. As we see a little bit of a bump up in the bond market in terms of yields, the dollar takes its cue from there as well, higher by 0.3%. Perhaps a defensive trade on the surface. But again, if the BOE comes out far more hawkish than expected, that's a trade that could disappear very, very quickly. A weaker dollar could then eventually lead to potentially more stock market gains. So, Anna, really a story of the domino effect today. And of course, NYMEX crude 73 handle, really following the risk sentiment. Again, you are seeing in the stock market higher by 1.2%.
Yeah, and here in Europe, this is the picture across those stocks then, Kriti, and we do have positivity here, up by just 0.2% in London, much more though in Paris, up by 0.6% or so. And if I show you what's going on with the consumer-facing sectors, we're risk on in that sense. So the sector breakdown shows that nearly all sectors in Europe are in positive territory. Consumer products and services is one of the best performing today, up by more than 1%. So the likes of Puma and Adidas, the sportswear manufacturers, but also luxury goods companies, all of those trade a little stronger today. Change at the top of Man Group is coming. The CEO is going to be retiring. Luke Ellis, someone we've spoken to on this network many, many times. He's going to be leaving the business, and the current president is going to be stepping into the role. The first female boss for this business, the first time a woman in charge in hundreds of years of history for the world's largest listed hedge fund. So that is in focus, not stock moving, but worth noting anyway. And this is the FX markets. Kriti, you were just talking there about the dollar strength, and it does seem to be that the dollar is in the driving seat here because we have weakness in both the euro and in the pound. Both of those could be driven by news flow domestically, but perhaps not so much just yet. The pound, of course, we wait for the Bank of England. We're at 125.90 as we wait to get that probably 12th increase in a row. More details on that in a moment. The euro is at 109.34. We are down 0.4% there. Interesting in the face of what seem to be slightly more hawkish comments coming through from Joachim Nagel at the Bundesbank, who's been speaking exclusively to Bloomberg at the G7 meetings. We'll play you some of that shortly, Kriti.
Yeah, and of course, as we talk about the rate story driving the macro trade, there's another one driving the macro trade stateside, Anna. It's coming down to the debt ceiling. Treasury Secretary Janet Yellen says a U.S. government default would undermine Washington's ability to provide international leadership. Speaking at the G7 summit in Japan, Yellen called such a scenario, quote, unthinkable.
A default on U.S. obligations would produce an economic and financial catastrophe. Millions of Americans could lose their jobs. Household incomes would be reduced, American businesses would see credit markets deteriorate, and millions of American families that receive government payments would likely be left without the resources that they were promised.
Joining us for more is John Herskovitz, Bloomberg East Asia government editor in Tokyo. John, a pleasure to have you on the show. Walk us through the thinking here. I mean, I think it's a no-brainer that this is going to be a disastrous consequence, one that we haven't seen in history, even though we seem to get closer and closer in each iteration. What is the thinking like on G7? Just how much panic is there?
G7 right now, people understand the situation that's going on and the enormous stakes that are involved. And the comments from Yellen just reinforce what could happen. And she's speaking to an audience that really understands the risk of a U.S. default. Meanwhile, in the U.S., we have Joe Biden. He went out to say to a congressional district in the Hudson Valley of New York, a swing district, to say the world is would be in trouble if there was a default. He's trying to pick off a few Republican votes. So we have this push at the global level with Yellen and this local level with Biden, just trying to get a vote or 2 or 3 or 4, whatever he can get, to get the votes that he needs on this crucial piece of legislation.
And John, let me ask you about another talking point over there at the G7, and that is around all things China. We mentioned in our headlines the thoughts around economic coercion, and that seems to be a geopolitical talking point. But in terms of the economics coming out of the world's second largest economy, the inflation numbers, I mean, they're really incredible. The drop down we've seen from 0.7% to 0.1% in year-on-year CPI. This is the kind of move that other central banks globally can only imagine.
Yeah, it's some of the worst numbers that have been seen in a couple of years, and it's really pushed the idea of whether macroeconomic stimulus or stimulus will be needed in some form. Now, we have the economy that's just really on the ropes coming out of the pandemic, the COVID zero policies, and at the same time, we have the G7, which has China clearly in its sights. The idea that they see China as a coercive power, and they want to take it on. Now, there's some debate as to whether this would mean decoupling, separation from China, or just de-risking, making China less crucial to global supply lines for key materials. But the G7 is looking at China, trying to see what they can do to minimize its importance in the global supply chains. So Beijing is getting squeezed domestically and on the international front.
John, thanks very much. Bloomberg's John Herskovitz in Tokyo for us, wrapping up some of the threads, some of the news lines coming through from those G7 finance and central bankers meetings. And don't miss our interview with Janet Yellen. You heard from her earlier. She's been talking at those G7 meetings. She's going to be speaking to Bloomberg tomorrow morning at 3:30 a.m. in New York, 8:30 a.m. London time. Now, the ECB Governing Council member Joachim Nagel is among the finance chiefs attending the G7 meeting. In an exclusive interview with Bloomberg, Nagel refused to rule out that interest rate increases could persist beyond the summer.
I guess there's nothing off the table, so I'm not speculating here. I think what I realize is that, first of all, and this is good news, that the headline inflation is coming down. Core is still very sticky, but this is also not a surprise. Food inflation is still very high. So what I see is that we are coming closer to the restrictive territory, but we are not there.
Joachim Nagel there. Alexander Weber joins us, Bloomberg European economy reporter in Frankfurt. Alex, good to speak to you. So is the consensus, what does the consensus look like then around the ECB? Is there a slight move towards a little more hawkishness, all this talk of ongoing hikes?
Yeah, it is definitely notable that Joachim Nagel and some of the other officials who've spoken recently are refusing to endorse market expectations, which are for just 2 more hikes in June and July. That reflects, as Joachim Nagel just said, concerns about really sticky core inflation and a sort of impatience that inflation isn't coming down fast enough. We've also heard from Isabel Schnabel, who said the ECB is going to hike until there's a sustained fall in core inflation. So far, we're still some way away from that because we've only had a very small dip in that gauge so far. On the other hand, there are officials like Bank of France Chief Eduardo Gallo who say the hikes are soon coming to an end. So even if we're talking about September now, we have to remember that there are still 4 more inflation readings coming in, 2 more sets of forecasts from the ECB. The ECB is very, very data-driven at the moment, so it'll be largely shaped by the data what's going to happen.
A perfect segue to talk about the survey of consumer expectations. What could the ECB do with that data? Just how much insight would we get?
I mean, it's definitely will be taken as a sign of concern. The ECB is watching inflation expectations very closely because they think that if they get stuck above the 2% target, they could perpetuate inflation. The survey has shown in recent months that inflation expectations had been declining among consumers, and now there's a very sharp bounce back up that will not be taken lightly by the ECB. It may reflect the fact that core inflation has actually continued to accelerate at the beginning of the year. So we need to watch how this develops in the coming months and what any turning point in core inflation, how it will affect these inflation expectations by consumers.
Alexander, thanks very much. Bloomberg's Alexander Weber there in Frankfurt for us. Now, in earnings news, Disney posted a drop in streaming subscribers and predicted a wider loss, despite CEO Bob Iger's aggressive cost-cutting strategy. Joining us now to discuss, Bloomberg's Alex Webb on set with me here in London. Good morning to you, Alex. So what does this subscriber loss, what does that mean for Disney? Because I thought the focus was supposed to be on profits and not subscribers this time around.
Yeah, I mean, I think what we've seen with Disney is they're in the middle of a bit of a pivot. They had really gone all in on Disney Plus in the effort to become a growth stock. Of course, growth stocks now, given the economic circumstances, given the rates conditions, are being punished. So they're sort of pivoting back a bit towards value. The CEO has suggested that the dividend might maybe reintroduced later this year. What Disney Plus itself is in the broader spectrum of streaming services is clear it's kind of discretionary. Like Netflix might be considered the base layer for some, and you add Disney Plus if you want it. Changes to new advertising tiers, things like that, have helped or hurt the business reduce the number of subscribers.
Well, to Anna's point there about the subscriber story, I mean, everyone was talking about how the parks business was going to be kind of the redeeming factor for Disney, and perhaps where a lot of Bob Iger's specific cost efficiency plans showed up. What have we learned about that part of the business?
Things really worked actually there, particularly in the international business, which returned to profit after having been loss-making. They posted quite significant profits in the park business, which now represent almost 3/4 of total profits. So it's, when you think about the way Disney is valued and when it was getting those huge valuations during the lockdowns on the basis of Disney Plus, a huge chunk of that business remains what some might consider a relatively stodgy theme parks business.
Alex, thanks very much. Alex Webb with analysis on Disney earnings. And we'll get more thoughts on Disney, the report they put out, what's the future looking like for this business. Citigroup's Managing Director, Jason Bazinet, joins us a little bit later on to talk us through his thoughts on the business. Coming up, Kallum Pickering will be with us, Berenberg senior economist. We'll mop up inflation data from the US and China, the world's two biggest economies. Really fascinating stories. We also get the Bank of England rate decision, of course. Plus, Bloomberg is live at the JPMorgan Global Markets Conference in Paris. Later today, we will be hearing exclusively from JPMorgan CEO Jamie Dimon. That's at 8:15 New York time, 1:15 p.m. if you're in London. Earlier today, we heard from Franklin Templeton CEO Jenny Johnson.
Banking is a game of confidence, right? And so if there suddenly becomes a wave of people who, via social media, start to say, oh, I'm worried about this, suddenly you do see this withdrawal. Hopefully that's calmed down and we won't see it. I don't know that we've fully seen the implications of what's happened with some of the regional banks, but I think we shouldn't see too much more. Yeah.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Look, we're talking a lot about the bond market, but let's not forget the stock market lacking a little bit of direction. If it's still all about earnings season, well, this chart will perhaps do you some good. For our radio audience, stick with me here. We are looking at the Citi Index that shows earnings revisions. And really what you need to know is you're seeing a whole lot of red going all the way back to, I want to say, the spring of 2022. So it has been a rough year for S&P 500 earnings specifically. A lot of people saying the recession we're talking about in the economy that's been just around the corner for the last 2 years or so. Well, the earnings recession is in the rearview mirror. It already took place as part of the carnage of last year. But here's the good news. There's a little bit of green on the screen, essentially saying that the forecasts are now coming in a little bit higher. Revisions are actually surging. So if that's the case, why is the equity market not moving higher? That's the question we're going to ask our next guest. Sagarika Jason Ghani joins us, our Bloomberg equities reporter. What is the stock market waiting for if the earnings are coming in strong?
Thank you, Kriti. Absolutely. I mean, earnings have certainly been better than feared. In fact, the guidance that we've heard from company executives has also held up. And yet, exactly as you said, the stock market reaction has been pretty muted. In fact, to just give you some context, the S&P 500 is only nearly flat since the beginning of the season in mid-April. Now, there's a couple of mixed signals that's driving that. On the one hand, the CPI numbers yesterday were certainly seen as encouraging for a pause in the pace of rate hikes by the Federal Reserve. But on the other hand, there's still lingering worries about the health of U.S. regional banks and more broadly of a U.S. recession later in the year. So,
yeah, so that's obviously weighing on things. I mean, stocks look a bit brighter this morning, don't they, Sagarika? Yes. But to your longer term point, I'm sure, yeah, fairly range bound. What about other things that markets might be watching in the earnings story, like buybacks, for example? We noticeably heard some of that from some in the energy space, but maybe not quite what they were previously. So how's that story developing?
Absolutely. I think buybacks was a very strong theme at the start of the year. In fact, January got off to a record start for the U.S. That trend, unfortunately, has not held up as we've proceeded through 2023. In fact, data from Goldman Sachs earlier showed that U.S. buybacks fell 21% in the first quarter compared with last year. And strategists say that they sort of expect that to continue through the rest of the year. So they see lower spending on both buybacks as well as dividends for the rest of 2023 as companies shore up more cash for capital capex and R&D, given the uncertain macroeconomic outlook. So that's certainly turned from a boost factor for equities to a pressure point through the rest of the year.
Sagarika, thank you very much. Bloomberg Sagarika, Jason Ghani joining us there with analysis on the equity side of things. For more market analysis across asset classes, check out the Markets Live blog, MLIV Go. That is the function to use on your Bloomberg terminal to find the Markets blog. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Now, keeping you up to date with news from around the world, here's the first word. For a third day, Israel and Palestinian militants in the Gaza Strip exchanged fire. Islamic Jihad squads launched more than 500 rockets towards Israel. Meanwhile, Israeli aircraft killed the group's chief rocket maker in Gaza. Efforts to reach a ceasefire have not worked. Ukraine is preparing for a counteroffensive against Russia, armed with more than $30 billion in weapons supplied by its allies. But the weapons may not be enough. To be successful against the larger Russian military, Ukraine will need to execute what's called a combined arms operation. That means coordinating infantry, armor, and air defense to maximize the impact. Donald Trump is urging Republican lawmakers to either get President Biden to agree to spending cuts or push the U.S. into its first ever default. The former president spoke at a town hall event with CNN in New Hampshire. He holds a tight grip on the Republican Party, and polls show him as the frontrunner for the party's presidential nomination. Microsoft has become the latest U.S. tech giant to tighten its belt. The software maker will freeze pay for all full-time workers this year. In a memo, CEO Satya Nadella said the move is necessary to generate funds to invest in the major platform shift towards artificial intelligence. Anna, there's that buzzword again, AI, when it comes to Microsoft. But at the same time, really looking at those cost-cutting measures and something that in the past the stock market has rewarded.
Right, yes, it has done. It has done. You wonder how long that continues to be the case. I mean, what's interesting here is there are sort of two drivers, aren't there? There's the AI driver that you mentioned, which is all about the sectoral shifts within the technology space, the way they need to invest to embrace this kind of technology to keep up, essentially, or perhaps to set the pace if you're Microsoft. But then there's also the macro trends, and we've seen others caught up in that as well, the likes of Meta and Amazon, and things proving difficult as rates rise for those in the technology industry, having to prove that they're more efficient. But if you think about, I mean, keeping salaries stable, I mean, this is a real terms pay cut, isn't it, for people who are in the US with 5% inflation or in the UK with 10% inflation still. That's how it feels when you take that pay home.
It absolutely does, and especially remember we're still talking about a war for talent when it comes to Silicon Valley and Wall Street right now. When it comes to an extremely tight labor market, a lot of folks, whether you're in software engineering or AI or coding or whatever it may be, they can easily pick up and go. So Microsoft really playing it hard when it comes to talent. I'll also say to your point, the key word that you use when it comes to the artificial intelligence battle is the word prove. Bloomberg Intelligence's Mandeep Singh says, look, there's a lot of people making big investments in AI. Not all of them will pay off, and that seems to be where the market is almost dislocated when it comes to pricing in the success there.
Yeah, that's an interesting take. And interesting that they actually talk about the tightness of the labour market, but actually maybe see it a little differently over at Microsoft, talking about how things have changed on the labour market front and on the consumer demand side a lot over the past 12 months or so. And so Satya Nadella and team seeing things evolving pretty quickly, I suppose, on the macro backdrop. Coming up, we'll talk macro then, Kriti. We'll talk to Kallum Pickering from Berenberg, senior economist there. We'll talk to him about the state of the US economy post that inflation data yesterday. Of course, we can take in China and the incredible drop in inflation coming through from the Chinese market, but also build up towards the Bank of England rate decision. We are expecting to get a 12th straight increase in rates today from Threadneedle Street. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. G7 nations will announce a joint effort to counter what they see as economic coercion by China. Meanwhile, Treasury Secretary Janet Yellen fires another warning, saying the debt default would hurt U.S. international leadership. The Bank of England comes out today with another decision on interest rates. Economists expect a 0.25 percentage point hike. And shares of Disney are lower. The world's largest entertainment company posted a drop in subscribers to its streaming service and warns there's going to be a wider loss this quarter. I'm Kriti Gupta in New York with Anna Edwards in London. Anna, a lot today just on the macro front, but I got to say a little bit of a stalemate. Yet on the earnings front, things seem to be moving. What do you see?
Yeah, here in Europe, we see European stocks moving a little bit higher, up by around 0.5%. Consumer products and services, that was the best performing sector last time we checked in a little earlier on this morning. We're seeing most sectors in Europe in positive territory, picking up on a little bit of the strength coming later in the day yesterday on Wall Street that perhaps we missed out on. But then US futures have been pointing higher as well. So backward and forward looking, there seem to be drivers to the upside for European stocks. So we go higher on European stocks. Man Group, just worth a mention because there will be soon change at the top. Luke Ellis is going to retire as the CEO. The current president is going to be made the new CEO over at this incredibly old and storied hedge fund, of course, the world's largest listed hedge fund. And they're going to put a woman in charge of the business for the first time. So worth a mention there. The euro is at 109.30, down around 0.5% against the US dollar on a day when we saw maybe at the margin some more hawkish commentary coming through from certain ECB officials. Certainly an acknowledgement that hikes are still ongoing at the ECB. But I suppose we heard that last week from Christine Lagarde, no pause. The pound is at 125.89, down by 0.3% for the UK currency. We're waiting, of course, Kriti, for details from the Bank of England, both on the size of the hike. The market is expecting to get a hike of 25 basis points. So we'll look for confirmation of that, but also any guidance about the future. We'll get into more conversations on that shortly.
Yeah, and a ripple effect that you're definitely going to feel stateside as well if it all comes down to the rate story and whether the BOE is essentially the last hawk standing when it comes to tightening rates. Well, that's going to have a ripple effect on the bond market, on the currency market, and then as a function, the stock market as well. For now, futures higher by about 0.3%, taking their cue from Europe, Anna, and essentially the momentum you are seeing there. But again, anything can change in just 3 short hours. The 2-year-old at 3.91. It is starting to pair a lot of those losses that we saw earlier in the session. So you are starting to see the yield actually come down just a little bit, but still higher by about 1 basis point. Again, it all comes down to the BOE. What do they suggest and what are the ripple effects for the rest of the market? The dollar taking its cue as well. Yields higher, but only marginally. The dollar seeing a little extra strength, higher by 0.3%. But again, £8 could change that. More action there at least could change that. NYMEX crude trading at a 73 handle. Interesting to see a little bit more of risk sentiment in crude and commodities reflect what you're seeing in the future story, because Anna, commodities are not necessarily kind of that recession gauge that we are so used to using them for. Instead, trading more on, again, sentiment and what the stock market and arguably what the bond market is telling it to do.
Absolutely. Let's get into our next conversation then, Kriti. Kallum Pickering joins us, Berenberg senior economist, on the day when the Bank of England meets to set interest rates. Callum, very good morning to you. So one of my colleagues said Happy Bank of England Day. I don't know if that's the correct greeting in the City of London, but maybe we'll make it a thing. Callum, talk me through your thinking then from the BOE. A 12th hike expected, 25 basis points, 7-2, the vote split. Those seem to be the expectations. What's your thinking?
No, I agree. I think the money market basically has it right. 25 basis points virtually guaranteed. I think almost all market economists are thinking the same thing. The question is going to be whether or not the Bank of England go again. We're looking probably at an upside risk for June, but it's certainly not guaranteed. What will matter is the Bank of England's forward guidance. Do they go Fed or do they go ECB?
Probably in the middle.
They stay in the middle. There will be data dependent, which means the complication for markets is what does the Bank of England forecast for inflation? And within the overall forecast, there will be a 3-month forecast for headline inflation. So basically, whether or not they hike in June will depend on where inflation comes in the next couple of months relative to what the Bank of England forecasts. So we probably don't find anything out today, actually.
OK, right. Well, that's going to be interesting in itself, I suppose, or infuriating. There seems to be this classic split in expectations between what economists are saying will happen in the next few months and what the markets are saying. A lot of economists saying this could be the last hike, whereas markets seem to have priced in a couple more. I mean, where's all that coming from?
Well, I think this should be the last hike, actually. All of the forward-looking data suggests that the Bank of England can look forward to some significant disinflation over the next few months, quarters. And keep in mind, for the UK, fiscal policy is tight. It's not tight in the US, it's not tight in the Eurozone. So that's also disinflationary. The market is duly reacting to the upside surprises in inflation data. The Bank of England thought in Q1 we would get 9.7% year-over-year average. It came in at 10.2. That's a big upside surprise. What I expect to see is the market basically come down if inflation comes in line with the Bank of England's expectations. And so I think the market needs to come back just a little bit.
Yeah, we kept thinking, Kriti, that we were going to get these prints below 10%, and we kept being denied. We'll see what the Bank of England has made of that.
Yeah, not a great sign, especially when you're dealing with a cost of living crisis that I believe at the IMF spring meeting said would last years, and not certainly seeing the pace of recovery that we're perhaps going to see stateside or even in the EU. Kallum, to that point, just when or what a kind of a beacon is the Bank of England looking for to take the same stance as the ECB and as the Federal Reserve that, you know, now it is the time to stop hiking?
Well, I think the problem that the Bank of England has is if you were to speak to the economists and policymakers, say, well, where do you think inflation is going to be 18 months from now? I think the consensus would be below 2%. And on that basis, you say, well, why are you hiking any further? But keep in mind, inflation data came in above expectations in context of an economy that was much stronger than expected. Now, I'm basically a known optimist on the UK, but even in the middle of last summer, I was expecting a 2.5% decline in real GDP over the course of winter. And instead, economic activity has been flat. So there's been a huge upside surprise in output. So if the economy is stronger than expected and inflation is coming in higher than expected, that is a signal that the economy is tolerating higher interest rates better than the Bank of England had anticipated. And so caution argues for the Bank of England to keep edging up. But once you get that inflection on inflation, then you can look to the forecast and say, well, let's just consider where the economy and inflation are heading. But we're just one meeting away from that, I think, and then June will be the decisive meeting.
So, Kallum, that's the rates picture. Let's talk about the quantitative tightening measures of the BOE as well. What can we expect on that front? Any sort of course correction there?
No course correction. The Bank of England is very confident that the UK banking system is well capitalised and has enough liquidity to tolerate any risks from the US market. That's important. And second, the bond market seems to be stable. I actually don't like the term quantitative tightening. I would prefer if we called it quantitative reversal. Why? Because the Bank of England, like the Fed and the ECB, are basically saying this is an operational consideration. We intend to do no tightening whatsoever. If markets are calm, this happens in the background, and then we'll pause if we see some problems in markets on the financial policy side. And so I don't expect anything economically significant from the Bank of England on QT, excuse me. It will just be in the background. We're going to continue this quantitative reversal, focus on interest rates as the marginal policy tool.
And Kallum, going a little further afield, of course, all this taking place in the backdrop of global markets, there's a lot of focus on the debt limit in the United States, and those conversations ongoing. We expect that to continue up to the well, who knows, X day, early June, perhaps. How are conversations with clients going on around this? I mean, are you taking our clients and the conversations adopting some nuance, or is it very binary? It's a sort of either it happens or it doesn't happen, and you prepare accordingly.
Well, so the US economy is the conductor of the global economic orchestra, absolutely no doubt. So what happens in Europe depends a lot upon what happens in the US. And so rightly so, people are nervous, but also no one really believes that the US will default, and they shouldn't either. So probably you do get some political fix. When and how that happens is uncertain. We've been here before on a number of occasions. For Europe, it really matters because the US is likely to head into a recession this year, mild recession with a lowercase m, but politics can have a bearing on economics. So if things really go the wrong way in the US, that points towards a deeper economic recession. And then Europe, which so far seems to have skirted a recession, is looking forward to a recovery, would then have to worry about more downside risks.
OK, yeah, we certainly had a guest on yesterday, earlier on Bloomberg TV, formerly of the MPC, now an advisor to the Chancellor in the UK, who was talking about the linkages and suggesting that this debt ceiling debate could be something that slows the pace of rate hikes in Europe. Kallum, thank you very much. Thanks for your time. Thanks for joining us. Kallum Pickering of Berenberg. Let me just get to some breaking news crossing the Bloomberg just in the last few minutes. Saudi Aramco is said to postpone postpone its IPO of its energy trading unit. There had been a plan to list the business in Riyadh in late 22 or early this year. They were seeking a valuation of more than $30 billion. The reasons that are quoted by people familiar with the matter who've been talking to Bloomberg, the business now feels it'll be difficult to list such a large business on the Riyadh bourse at the moment, and the Saudi firm also wants to take more time to complete the integration of its main trading unit with the trading arm of its US refining business, Motiva Enterprises. So a lot to think about when it comes to that listing story and no doubt the energy markets. Coming up, we will get back to some of the corporate earnings stories we've been following over the past 24 hours. Disney in focus. Jason Bazinet joins us, Citigroup Managing Director. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an exclusive interview with JPMorgan CEO Jamie Dimon. This is 8:15 a.m. New York time, 1:15 in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Anna Edwards in London. Has Bob Iger lost his magic touch? Disney shares are falling in the pre-market. It kind of seems like it based off that. That's coming after another drop in streaming subscribers. Joining us now to discuss is Jason Bazinet, Citigroup Managing Director. He's got a buy rating on the stock and a $130 price target, implying about 37% upside. Jason, a pleasure to have you on the show. Thank you for waking up early for us. This story of cost efficiency is something that is going through all tech names, if you can include Disney as officially a tech name. Talk us through whether or not Bob Iger has delivered that cost efficiency in the first quarter.
Well, they did in the first quarter, but as you pointed out earlier, they noted that the losses on the streaming side are going to get a little bit bigger in the next quarter, and I think that's given the street some pause. If I could just sort of frame it for you, I mean, Disney last year did $11 billion of EBIT, and there were $4 billion of losses embedded in that number on streaming, and so the street is just laser focused on getting those $4 billion of streaming losses to zero by the end of next fiscal year. And so this step backwards, if you will, that the company telegraphed, I think is giving the street a little bit of jitters today.
So where does that come from then? When you're talking about making those changes, bringing that number down to zero, does that happen in the streaming business or does that happen in the parks business and the amusement business, which I believe the consensus from the street was that this time around, this quarter, that was really where most of the growth was going to come from?
Yeah, no, that $4 billion of losses is all in the streaming business, and the street is focused on the streaming business going to break even by the end of fiscal 24. The parks business, you know, there the concerns are a little bit different. It's a little bit macroeconomic. Those are the jitters, but they put up very good park numbers. And so there's no concern about a recession, at least in these numbers.
And in terms of that streaming business, good morning to you, Jason. They seem to be taking action on both the costs and on the prices. Bob Iger talking about how they want to increase the prices of their ad-free Disney Plus service. They're also looking to bring down costs, though, by removing some films and TV shows. How does the math look on all of that? Is that going to be enough?
Well, it will be enough. I would add to that they're going to take a $1.5 billion to $1.8 billion write-down to sort of get rid of some content where the cash was already spent, but those costs are being amortized through the income statement. And so that's a third leg of the stool, I think, that's going to be needed to get to break even on the streaming business. You know, the price hikes that Mr. Iger talked about is very consistent with his message from prior quarters. They think they've underpriced the streaming services when they're in the mode of trying to get net adds. Now they're much more focused on profits. And then there's another element to this as well, which is they announced yesterday that they're going to, in the U.S. at least, combine Hulu and Disney Plus into a single app. That eventually will allow the firm to remove some duplicative infrastructure costs that are now being borne by the company to support both the Hulu platform and, quite separately, the Disney Plus platform.
Okay, and what does that tell us about the future around Hulu? Because I know some people have suggested that this move means they could end up buying Comcast 1/3 stake in Hulu, but others suggest this means something different for Hulu. So what's the future there?
Well, this is a little bit confusing. There is no doubt that the street would love to see Disney get rid of Hulu. The street is not a fan of Hulu. Mr. Iger last quarter called, he said he was uninterested in undifferentiated general entertainment content, which was code for Hulu. This quarter, the negotiations are still in flux, but I think the buy side probably nudged up the probability that Disney is going to end up owning all of Hulu. And so the street would say that's a negative. I look at that and I think it's a positive. I mean, one of the really interesting things from my perspective is, as all of these media companies focus on cost cuts, there is really nobody other than Netflix that is out there that really has the breadth to be what I'll call a pay TV substitute, right? All the other services are sort of niche-y. By bringing Hulu and Disney Plus together with Disney's scale, you're actually in the same zip code as a Netflix. Most of the other streaming apps that are out there are not in that zip code. And so I think it's quite good and quite bullish for Disney long term to actually be sort of the TV substitute in a streaming world.
Well, Jason, let's talk about the cost efficiencies that you are laying out, but in the context of the writer strike that we are seeing in California right now, to what extent is that going to eat into the bottom line when it comes to higher wages?
It's really small. If you look at the Writers Guild and their ask, they would say that what they're asking for is about $500 million a year. What the studios have offered is worth about $100 million a year. So that's sort of the bid-ask spread between the two. If you took that $500 million a year, let's just say that the studios gave the writers everything that they wanted, and you put a multiple on that business that's higher than where a lot of the media companies trade, it represents about 2% of the market capitalization of all of the Hollywood studios. And I'm not even including, some companies that would be in that business. I'm just talking about the companies that we cover. So it's really small. It's not really a large factor at all.
Only 2%, but certainly some developments that we're going to be keeping our eye on. Jason Bazinet of Citigroup, we thank you as always. And of course, he's talking about a $130 price target, about 37% upside. When we take a look at how it's trading in pre-market right now, still got a ways to go, trading with about a 95 handle, down about 5.4%. Again, still very sensitive, Anna, to those streaming losses and the idea of shifting the focus more towards the parks business, which, by the way, was pre-COVID a good chunk of their core business. Feels like the narrative has been a little bit lost there. Nevertheless, those shares down about 5%. Another stock, of course, in the kind of tech arena, if indeed we can call Disney part tech, is Google. Those shares are higher by 1.7%. Alphabet, Google entering the foldable market with about $1,800 phone in a direct rival competition to Samsung. This is really important. Samsung is the primary kind of iPhone or smartphone maker, for a lot of the emerging markets. So Alphabet, if it were to break into that market and eat into that market share of Samsung, could mark some very significant upside for Alphabet. And that's exactly what the street is smiling on this morning, higher by 1.7%. And speaking of things moving higher this morning, let's talk about Robinhood. It has taken a beating for quite a while, but overnight, Robinhood talking about bringing 24-hour trading on weekdays, pushing the stock higher by 4.7%. This is during their earnings, of course. Now, earlier in the session, I should say after hours yesterday, you saw an immediate double reaction to the CME group. Essentially, the idea that you are not going to need traditional exchanges anymore if you have something like Robinhood that's going to talk about 24-hour trading. It seems in pre-market, we're still seeing a little bit of unchanged action right now, but keep an eye on this stock because as you see Robinhood trade, some of its other peers, like CME, for example, may take a little bit of a hit, Anna.
Kriti, just getting to some breaking news across the Bloomberg terminal then. A CDS panel is going to be asked if Credit Suisse AT1 wipeout is going to trigger a payout. So this is what happens to all those who bought insurance against default on those AT1s. The AT1s were wiped out, of course, by the deal between UBS to buy Credit Suisse. And so that is something we're going to be watching. The panel involved is the Credit Derivatives Determinations Committee. They're going to be deciding if this AT1 wipeout is a trigger payout, if it will trigger compensation for insurance holders, essentially. This is Bloomberg.
There is a real risk that Sunak's inflation target won't be met, and I actually think he would have done better to leave discussions of inflation to the Bank of England.
That was the former Bank of England MPC member Martin Weale speaking to Bloomberg's Lizzie Burden. Sticky inflation in the UK looks to be putting pressure, of course, on the Bank of England to continue hiking rates today. And Lizzie Burden, who was talking to Martin Weale there, is with us now. She's outside the Bank of England for us this morning as we build towards a decision which comes in around an hour's time. Lizzie, what do we expect?
Well, Anna, markets and economists are in agreement this time that rates are going to rise 25 basis points to 4.5%. It'd be the highest level since 2008. So the real focus today is the future path for rates. Any hints on that from the governor and his colleagues at the press conference and the interviews that will follow, as well as in the forecast. Now, markets are predicting that they're going to hit 5% potentially by September. But we were speaking to Sushil Wadhwani, former Bank of England policymaker, yesterday on Bloomberg Radio, and he said that would be unwise given the potential spillover risk from a US recession, given all the recent turmoil around regional banking there. In terms of the vote split today, we're expecting 7-2. That's what economists reckon. It would be the same as last time. But the risk would be that you've got hawks on the committee who could be spooked by that recent upside inflation surprise and actually go for a 50. But at the other end of the spectrum, you've got doves like Silvana Tenreiro who say you need to take account of the lag in monetary transmission. It takes 18 months to 2 years. She says being a hawk right now is like being a fool in the shower, turning on the tap, keep turning it, not being patient enough to wait for warm water and scalding yourself in the process.
An experience I can certainly relate to. Lizzie, in about 30 seconds, how much forward guidance will there really be?
Well, you've got to ask how credible the Bank of England can be if it does anything other than say that it's data dependent, given all the surprises we've had on inflation and the labour market recently. But it'd be interesting to see where the Bank of England reckons inflation will end the year, given what Martin Weale just said. It's the Prime Minister's #1 target for it to halve by year end. Only a few weeks ago, it was seen as unambitious, as ambitious as saying that the sun's going to set at the end of the day. But now it looks like it's in doubt.
Lizzie, thank you very much. Bloomberg's Lizzie Burden for us outside the Bank of England. And certainly we'll continue to cover the Bank of England story as it develops today. We'll bring you their decision, of course, and any forward guidance we do get. That is it for Early Edition. Don't miss our exclusive interview with JPMorgan CEO Jamie Dimon, 8:15 New York time. This is Bloomberg.